All right, welcome back. Altimeter's Brad Gerstner.
He's an amazing investor and leader in Silicon Valley.
Today you got $22 billion.
This in my hand here, that now famous letter to Mark Zuckerberg.
I had investors call me up telling me what a fool I was. He believed. He said, flatter is faster, leaner is better. 40% of your revenue today is inference.
It's about to go up by 1 billion times. That's right. That's right.
NVIDIA is not just in the business of generative AI. It is our biggest holding today. Going to have to replace the $1 trillion of CPU-driven data centers. There is no intrinsic value.
He has a vision.
Technology enables value that consumers are willing to pay for.
And he's not going to be knocked off the vision.
Are you leveraging AI to increase productivity, reduce costs?
Increase value, reduce waste, right? That's the practice.
Yeah. I mean, it ain't Diplo, but we're going to have fun.
So you really don't need much of an introduction, but for those of you who don't know, Brad is one of the most successful VCs of this era, for sure. Returned, how much have you returned in the last 3 years, 4 years?
More than we've ever raised.
Yeah, it's a big number.
Yeah.
And Brad is also known as the chart guy. I remember actually the first time I saw you, it was probably the All-In Pod. And the engineer in me just loved the charts. I was like, I love how this guy goes through this. So we decided the charts were a big hit last year. So we're going to let Brad kind of tee up where the market is right now and run through some charts for you.
I actually run an investment firm, early stage venture, late stage venture. I've been in Silicon Valley for 25 years. And so I actually, like when we have a conversation this week about DeepSeek, I don't like to hyperventilate. I like my team to actually do the work, build the model, so we can have a real conversation. Now is a time that you can generate a lot of alpha. The last 2 years, we're up 169% versus the S&P up 53. The point of that slide is in the moment of big phase shifts like we're in, internet 2000 to 2004, cloud and mobile 2010 to 2014, and now in AI, it's the fog of war. People don't know which way is up. I mean, look at the trillions wiped out of the public markets yesterday because a butterfly flapped its wings in China.
Literally.
Really? And so that is a huge advantage for those of us who do this, for a living. Something that you and I have talked about over the last couple of years we got well known for was this letter in the fall of 22 that we wrote to Mark Zuckerberg called Time to Get Fit. And it was this open letter about the opportunity for incredible margin expansion. And what most people didn't understand at the time, it became our biggest holding, almost $1 billion position, $90 a share. Today it's $670 a share. And the point was there was amazing untapped potential at Meta, right? Number one, they had 87,000 employees. He let 25,000 go, got down to 62,000 employees. And this company still 2.5x'd its top line. How? Leveraging AI, right? And so at the time, this was pre-ChatGPT, we said you got to cut your spend on Reality Labs and double down on AI. So as investors, we walk the walk, right? And Mark sat down and talked with us because he knows we're doing the work in that period of time. But if you really just think about why we invest in technology, if you look at the last 10 years, last 15 years, last 20 years, tech has been the biggest free lunch in investing. Tech earnings have compounded at 14% versus non-tech earnings compounding at 7%. So it's not just that, these are high multiple stocks. No, it's these companies are twice as profitable and growing twice as fast as non-technology companies. As we sit, over the last 15 years, tech has gone from 5% of global GDP to 15%. And if I asked anybody in this room, do you think tech is going to be a bigger percentage of global GDP in 5 or 10 years? You would all say yes. And if I said, do you think it's going to continue to out-earn non-tech? You would all say yes. Our job is to find the best of tech and avoid the worst of tech, because the one downside of tech is disruption. So companies that you think are great today, Nokia in 2009 can be eviscerated, right? AOL, eviscerated. Yahoo, AltaVista, eviscerated. So that's the puzzle. That's the game that we get to play. So as we look at this year, what is the market pricing in? What are they not pricing? I'm going to give you a little bit about the macro backdrop. I think the big thing to keep your eye on this year is the 10-year. Okay, we're at 4.5%. Rates are too high for the average economy. The housing market's in a recession. The auto market is in a recession. We have a rolling recession through the economy because rates are really high. Why are rates so high? Not because the Fed's not doing its job, but because the market is stimulatory, right? We're going to extend the tax cuts under Trump, and the market doesn't think we're going to do anything about the debt. That's why the bond market went from 3.5 to 4.8 on Trump getting elected. What it was saying is you're going to cut taxes and you're not going to do shit about the debt, and we're calling your bluff. And we know all the greats were out there shorting the bond market. So the question is, at 4.8 or 5, the equity markets will not work. Inflation expectations have gone up because of this. Everybody's saying the deficit's going to go up. We're in a debt spiral. The bond market vigilantes are coming out. I happen to be helping out on Doge with our good buddy Elon. I actually think I take the over on this. We are going to do something. This is the first administration in my lifetime that has the ability to do something about this, because you have both houses of Congress, you have a president determined, you have Scott Bessent, Kevin Hassett, and you have this phenomenon called Elon Musk. And so this is a little bit, I'm not going to spend time on this, but here's what I think is possible. I think you can balance the budget in 2029 in this president's term at $6 trillion. What that does is return us to the 2019 baseline. If you take 2019, you grow at 3% to 2029, you would spend $6 trillion, okay? In 2029, we'll have $6 trillion in federal revenue. It's actually not that hard. Don't buy what they say, right? You can make these cuts. If you do this, now all of a sudden the bond market rolls over, the 10-year comes back to 3.5, and it's the golden age. We're off to the races. But we need the president and Doge and Congress to actually make the cuts to get us back on this path. Mentioned rates are still restrictive. So I gave you the setup, basically the macro backdrop. Well, is shit expensive or is it not expensive? And what are the earnings expectations? This is, I think, really interesting. Last year, tech earnings grew 44%. This is Mag 5, grew 44%. The consensus expectations this year are 20%. Non-tech only grew earnings last year 2%. Wow. Look at the huge acceleration they expect this year, 11%. Okay, so everybody's like, oh, well, tech's expensive. I'm going to go hang out in this non-tech. Non-tech has to have a huge earnings acceleration. Where do they think it's going to come from? Let's break it down a little bit. What categories? Healthcare last year grew 4%. This year, consensus thinks healthcare earnings are going to grow 20%. Last year, industrials, -4. This year, they think 16. That's a freaking high bar. Yeah. I'm not sure where those earnings are coming from. And if you look at the multiples against the 5-year average, non-tech is actually trading higher relative to its 5-year average than tech is. So not only is their earnings bar higher, but it's actually trading at a higher relative multiple to the 5-year average. So a couple things, and then I'm going to yield back my time, Ron, because I'm filibustering, because I know you're going to ask me hard questions.
You had a lot of charts.
The biggest thing, and this will get to DeepSeek and everything else, our most non-consensus opinion is the world is underestimating the amount of compute that's going to be demanded for the next 3 to 5 years, right? NVIDIA is the poster child for this, but it's a lot of things. It's everything required to be consumed, from memory to power, in order for the world to make a transition from an x86 Intel-based architecture to an accelerated compute architecture largely driven by NVIDIA. And you see, this was even before DeepSeek. This was the setup. People were like, scaling laws, we're hitting a limit, right? That small models and open models and all this stuff. So I put this together in December. Right? And so yesterday was a continuation of this question mark. But if you think about this new super cycle, OpenAI raised money at $150 billion. It's the fastest growing company in the history of capitalism. OpenAI is doing far more revenue than Google was at the time of its IPO, has far more users than Google had at the time of its IPO. It's just a private IPO, right? We're investors in OpenAI. If you look at CapEx, everybody talks about the $250 billion all the big companies are spending. It's one of the greatest assets in the United States of America, right? Compare this to the R&D that's going on in China. R&D in China is 100% the state. It's the government. Here, it's all these companies with literally printing presses in their back rooms plowing all this money, $250 billion a year to keep the United States on the front edge of tech. And notice, people are saying, well, we got DeepSeek, you're not going to need to spend this money. 2022, before we even talked about models, before there was no model training, we still spent $150 billion on GPUs. GPUs run all of technology now. Every single Google search you do requires accelerated compute. Every single time you do an inference transaction on Instagram requires accelerated compute. It's not just about training a model, it's about running all of these businesses. That's how their revenues have accelerated, because accelerated compute is a lot smarter at targeting consumers and doing all the things that these companies do. I'm gonna leave it there. There are a couple more that we could get into, but let's go have a little back and forth.
All right, so can we start with DeepSeek? Because this was like an atom bomb, basically, in the AI world yesterday, which, I mean, I'm far from an expert in AI, but it felt like it certainly caught everyone by surprise in a major way. Could you just start out by explaining what it is? Because I suspect a lot of people in the audience don't fully understand.
Yeah, I mean, DeepSeek is an open source model. The company's been around for a decade, one of NVIDIA's closest partners, incubated, not surprisingly, by a quant fund in China. Remember, quant funds have been doing AI for a decade, right? Like you get a millimeter advantage in a quant fund, it's a license to print money. They have huge incentives to be really good at this, and so they've been working on this. Before the export bans, they were buying tons of NVIDIA GPUs. Even after the export ban, they were buying a bunch of deprecated GPUs. And what was disruptive yesterday was not the model that they produced. The model they produced is basically O1 and O1 preview quality. That's where OpenAI was a year ago. To put it in perspective, internally, OpenAI is already on O4, 4 generations ahead of the model that was released yesterday. So it wasn't about the benchmark, it was about the cost. They said it cost us $6 million to train this model. And all the talking heads went on CNBC and said, oh my God, OpenAI is spending $500 billion. I just saw Stargate announcement, and these guys did it for only $6 million. But nobody asked the question. OpenAI hasn't publicly talked about what they spent to train O1.
Right, I was just going to ask you
right,
that.
so isn't that the logical question you would want to know the answer to? What did OpenAI spend to train O1? I'm an investor in the company. Noam Brown, who is the inventor of O1, is an advisor to the firm. Would you be surprised if OpenAI spent less than $20 million to train O1? That's my speculation. I think they spent close to 12 or 13 million. He had a tiny team and tiny compute, okay? And if you think about how compute depreciates, so GPUs get 2 to 3x better every year, which means the cost goes down by 50% a year. So if you spent 12 million, and these guys do it for 6 million, it's in the center of the bullseye of the expected amount that they would spend. I think that's highly informed speculation by me in terms of what OpenAI spent. And so the point being that when you're in the fog of war, when you're early in a phase shift, that's when partners like Altimeter can offer great advantage, whether we're partnering with sovereign wealth funds, endowments like we do, or families like we do, because we live and breathe this stuff every day. We're not only investors in OpenAI, but we've looked at every model company that's come through our offices, and we're investors in NVIDIA and Microsoft, et cetera. So it's about putting together those data points, and on a day that the market is panicking, we were buying. We were pushing risk on the table when everybody else is capitulating because they don't really have conviction. They're passengers, they're tourists. They have derivative conviction. Right? And derivative conviction, when the market is moving against you, will get you run over. And that usually happens. I mean, I remember I got into this business on the public side, 04 and 05, and I would own Google, and it'd go down 10% for the day, and my partner would come into my office, what are we going to do about it? I'd say, buy more and go to sleep. You know, because I know next year Google's going to do more searches than they did the year before, and I know the revenue per search is going to be higher than it was the year before. Boil it down to its essence, right? And so I think when you look at DC, it was not disruptive in terms of training costs. It's not disruptive in terms of inference time reasoning costs. And again, we have very good understanding of exactly how many GPUs they have, and exactly the cost of running the GPU. But it plays into narratives that in the fog of war, you see how the mob rule can move. That's Mr. Market. Buffett tells us all the time, Mr. Market could put shit on sale and panic for any number of triggering reasons. right? And so I think yesterday, if your conclusion was that all of a sudden we can have all this compute for free, right? You're 180 off the target, right? We will have a shortage of compute in the United States of America for the next 3 years, almost guaranteed.
So you're expecting then the market is just behind where you are. They just haven't really fully appreciated yet the numbers you just shared with us, what OpenAI spent on it. Where does it go from here?
You see the market, our portfolio is between the 2 days, and this is welcome to my world, because I have big LPs, sovereign funds. They're like, oh my God, I can't believe we own so much of this stuff. This is terrible. And then I'm buying a bunch of it and it's up just as much today. And they're like, oh my God, this is great. You were totally right. It's hard during these moments, but that's why you have to have partners who've been through 3 of these super cycles and lived through the volatility, of these moments. Here's the thing. I'm on Team America. I want us to win the race in AI. We have the most R&D in the world. We have the best chips in the world. We're doing all these things. But we shouldn't be naive. Mm-hmm. China will have great AI. We will do some things not to make it particularly easy on China. We can do anti-distillation at OpenAI. We can have, chip bans so they can't have our most bleeding edge chips. But trust me, none of that stuff is going to prevent China from having really good AI. What we need to focus on is running the race as fast as we can. Not how fast my competitor's gonna run it. We need to get the regulatory bullshit out of the way so that American companies are not hamstrung to win the race. And it's fantastic that we have Elon competing against Sam Altman. I love their jawboning on X. Let the competition ensue. That's why we're so good. Okay? And by the way, nobody's talking about Google yesterday, but Gemini with deep reasoning is far better, right, than DeepSeek. And so we're early in the battle. Final comment on this. The model layer. We passed on almost every one of these models. Anthropic, Mistral, go through the list. It reminded me of 1997, 98 in search. Alta Vista, Lycos, Ask Jeeves, AOL. The fact of the matter is there's zero intrinsic value to the model. Just like there was zero intrinsic value to the web crawlers and page indexers at Alta Vista and Lycos. What's valuable is when a consumer says, I'm going to use you, and I'm either going to look at your advertising or pay you a subscription fee. That's why Google won. In '98, we all thought we were geniuses. We all knew search was going to be the dominant winner on the internet. But all of those companies went to zero. And you could have waited until 2004 and bought the Google IPO, and you would have got 98% of all the profits ever generated in search. Okay? Why are we investors in OpenAI? Because when I look at it, the indicator I was looking for is who breaks out, who wins. It tends to be winner take most. In 2004, when I bought the Google IPO, they had 250 million weekly average users. When we invested in OpenAI, they had 350 weekly average users. There's a critical mass, and if you look at the numbers since then, they've continued to skyrocket. They captured the zeitgeist. They were the first mover. They produced a really good product. And so, it doesn't mean they can't be disrupted. But the market leaders who get that sort of critical mass rarely are. And there's not a company on the planet that has 1 billion weekly average users. It's not worth $1 trillion.
You had a great run in 21 and a very tough 22. Yeah. It's hard to argue with, frankly, most of what you say because you're so researched on this and you know the numbers cold. But how nervous are you, especially after yesterday, that maybe we are at a peak and this whole thing is going to burst?
Let's compare relative valuations, okay? In the fall of 21, because the government had gone full ZERP on us, literally paid us to take risk. Negative interest rates and then 0% interest rates had the greatest distortion on the market in my career, 25 years of doing this in the public markets. Software multiples went to 18 times forward revenue, okay? The 10-year average is 6.2, okay? And we're at 18 times, right? huge standard deviation above what you would have expected. And there was only one reason for that. The government got exactly what they wanted. When you have a 0% interest rate, the hurdle rate for the alternative for your money is 0, so you push, you get into the equity markets. That's what they wanted to do to prevent the economy from crashing. We made a huge mistake, and we kept 0 rates for far too long, as we all know now, which ignited, basically hyperinflation for a moment. Today, that same software company is trading below the 10-year average at 5.7 times forward earnings, okay? So I hear a lot of bubble talk, and trust me, 25 years in Silicon Valley, having lived through a couple bubbles, I'm always on the lookout for the bubble. When you're talking about the bubble, there rarely is, right? I did CNBC from Milken, I think down here, in October of 21, and this is what I said. COVID's over, rates are going back to where they were before COVID started, and multiples will go back to where they were before COVID started. That's the reset in 22. That's what you had to get right. Nothing else. 22 was not about stock picking. 22 was recognizing a macro shift from 0 rate bound to a much higher rate bound, and it went way higher than anybody expected, right? The Fed was caught way offside, and we went from the easiest money the country has ever seen to the most restrictive policy we had seen in 20 years within 10 months, right? So I think, don't use that for any pattern recognition except the next global pandemic.
Talk to us about 2025. What investment themes are you focused on for this year?
Yeah, so, again, it reminds me of 2002. Everybody got really, because we had some days like yesterday in the internet, everybody's like, oh, the internet's a fad. Amazon's never going to sell all this stuff. It's like you go through these moments of despair. Mm-hmm. And I hear the same things about AI, right? Are you ever going to earn a return on these investments? Talk to anybody in business today. Your company will not exist if you're not leveraging AI in 5 years, right? In the same way that no company can exist without the internet. Right? And so it's just the time series that we're really talking about. So for me, the primitive to all AI, and I'm talking whether we're using ChatGPT, whether we're using Google Search, whether you're using Instagram, whether you're using Microsoft Teams, whether you're using any enterprise product, because it's all going to rely on the exact same accelerated compute and inference in AI, that requires compute. What I mean, like AI compute, NVIDIA compute. Yeah. And that requires SK Hynix and Micron. It requires, the whole custom ASICs movement requires companies like Broadcom and Astera Labs. It requires power, right? Like Vistra, or you see, we did a pod from Diablo Canyon, the nuclear facility in California. The reason we did that is because we said we need to set nuclear free in this country. So now we see Amazon and others who are negotiating directly with nuclear facilities to set up AI data centers right next to them because they're massively power consumptive. So I think that whole complex is underappreciated. Yesterday took even more gas out of that complex, and so I think it's one of the easier trades. NVIDIA trades at 24 times next 12 months earnings, which by the way is one of the lowest multiples it's ever traded at because we have a wall of worry. So that's one. Number two, market leaders and margin expansion. This was the meta trade, right? When I bought that, when I wrote that letter and you and I talked and backed up the truck on it in the fall of 22, every headline, Meta's dead. It's over for Meta. Zuckerberg's driven the company off a cliff. Gerstner's an idiot for this letter. Mark will never do what he's suggesting. You have to have the conviction that can withstand that, okay? But what did he do? He radically expanded the margins of the business because he grew the top line and didn't grow the bottom line because of AI. Every market leader, not just in technology, has an opportunity to do that, right? I just spoke with one of our investments who's here today, a great company, and he said, we've 2x'd our top line over the last 2 years and our OpEx is flat. Exactly. Build that into your DNA, get fit, leverage AI. This is the opportunity. The companies that do that are gonna have great runs, and the companies that don't are gonna be on the wrong side of history. And there are gonna be some seminal examples. Over the last 20 years, our entire career, for most of the people in this room, if you invest in technology, the architecture of technology was the internet. And Google was the apex predator, okay? Why? They gave us these 10 blue links that allowed us to have access to the world. And for the first time in 20 years, that is at existential risk. Why? Because my sons they're like, why would I look through all these blue links? I just want the answer. ChatGPT gives me the answer. They talk to ChatGPT at night. It's their specialized tutor in my son's honors chemistry class or AP history class or whatever you name it. This is the first generation that will be ChatGPT natives. Right? In the same way we felt about the internet during that period of time. And like those who grew up with the internet would say, what? You used to use a card catalog? You went to a library? What's a library? And you pulled this thing out and you had to pull the card out and go find a book? Like that's how you got the answer? Right? And so this is highly disruptive to the entire economic architecture. So you have to look at companies like Google and say, will it continue? You have to, even if they're great at AI, they have the greatest business in the history of the world that's getting disrupted. Booking.com, Expedia, Zillow, all the companies that lived in the underbelly of that search ecosystem, disrupted, right? And so I get excited about that because we're moving the world positively in a great direction. But yes, technology faces, these waves of disruption, and it can be very dangerous in venture. Because venture often takes 10 years. You may make a great bet this year. 3 years from now could be totally eviscerated. So from my perspective, we've done very little in early stage venture and AI. The discount rate has gone up. What do I mean by that? It means my ability to forecast the future in 3 years, given the pace of change, is very low. So I have to be humble in the face of that. If there's a startup company with 10 million in ARR that's growing 50% and everybody says, oh, slap a 10x multiple on that and do the Series B or do the Series A. I say, I don't even know if the world's going to need that company in 3 or 4 years. Okay, let me just give you one example. I know you're going to kick me off stage, but they took more time, so let's us take more time.
Exactly.
Okay, so I had a bunch of meetings the last 3 days. And I'm sure somebody on my team who was in the meeting with me left the meeting, went back to our Salesforce instantiation, typed in these little boxes, who we met with and what the conversation was about. We have this CRM that keeps track of it. And then when I want the information, I'm like, how do I get this information? What I want to do is just put my phone on the table. ChatGPT listens to the conversation. It summarizes the conversation. It knows who I'm talking to. And the next time I'm going to have a conversation with Ron, I just say, hey, Chat, what was the last conversation I had with Ron?
Yeah.
And it just tells me. That is a potential disruptive force to application software that has never existed. So I had a slide up there that went kind of viral on our pod when Satya said, application software is just a thin layer that sits on top of a CRUD database. That's what he meant, right? He's like, that's all dead.
Right.
Okay, so you're hanging out. Think about your diversified portfolio. I own Salesforce.com. I own Google. I own Booking.com. I own all the market leaders. And by the way, all my friends in all great companies. And they will all make the pivots necessary to continue to be great companies. I'm sure at least there are sleepless nights trying. There are times in tech where you can set it and forget it. Just let it compound. You're early in a super cycle, and you're on the right side of the wave. But there are periods of time when the things that you saw compound for the last 15 years in a straight line. I had dinner with my 88-year-old mother on Saturday night, and this was the conversation. She was like, how should I be using ChatGPT? Oh, you mean I'm not going to use Google so much? I should sell that in my portfolio.
Good thought, Mom.
I know, but this is, this is where the rubber meets the road. And so for us, I get the great fortune to get up every morning, talk to the brightest people in the world, and get to play anthropologists. I have an incredible team, and we get to try to answer these questions, and we put together these charts, and we try to put together a forecast for the way the world is going to evolve. And we have incredible partners who think we're okay at it, and it's led to good results by investing across 4 super cycles over the last 20 years. This is the most exciting point in my career.
So the thing I love about having you here is there's literally no one more passionate about this business and just about the future of the world than you. Really just try to do this in 2 minutes, but you got to tell us about your Invest America project.
Yeah.
Because what I love about it is it's a way for you to take all the things that you love about the country, about technology, and try and put it in the hands of way more Americans than it is today.
Well, thank you. And I remember a great moment for me last year was you had Jared Kushner on stage. And he came up just after me, and you said to Jared, hey, Jared, you hear what Brad just said about Invest America, and what do you think about it? And he said, he's crazy enough to make it happen.
Yes.
And he's like, 99% of people come through Washington, have a great idea, throw it over the wall, and that's it. And that's not how it's not how companies get built, and that's not how ideas happen.
Yeah.
Right? I put thousands of hours into this. And I'm happy to report, so for those who don't know, the idea is very simple, that we have the only threat to democracy, the only threat to the greatness and the competitive advantage we have as a nation is that we attack ourselves. And we have an unstable situation because 70% of the people do not enjoy the upside of compounding, right? They feel like the system's rigged against them, that the oligarchs and the rich folks get all the money because they're participating in the markets. But if you look at, inflation-adjusted real wages over the course of the last 8 years, they're flat. People don't feel, there's a reason people are angry. There's a reason people don't feel like they're winning, because they're not.
Yeah.
Right? We got to get everybody in the game, everybody on Team America, everybody aligned with capitalism, and we can do it very inexpensively. Everybody there are 3.7 million children born in this country, and when you have a child in the hospital, you fill out a form because that's how you get your Social Security number. Every kid has to do it. That's how you prove citizenship. At the time we do that, we ought to give them an Invest America account. So the Treasury Department will cause to be created 3.7 million private accounts a year, seeded with $1,000 in the S&P 500 that they can't touch or trade, but they open their phone, they see they own a little slice of Apple, of Berkshire Hathaway, et cetera. They call it the money page. And it's managed by private market participants on private label to the federal government. What I would say is this: we have bipartisan legislation moving through the Senate. We have a House and a Speaker who very much want this to happen. And I'm happy to report that now we have an administration that we have a tremendous amount of support and progress with. But everything in Washington is a long putt. I think we're going to get it done. I think we can get it done soon. I'm hopeful that it will be part of this reconciliation package led by Scott Bessent and Kevin Hassett out of the White House, who are both big fans of it. There's the right thing to do for the country.
Yeah.
Right? It will make us stronger because it gets everybody into the game. And just the total cost, because I'm helping out on DOGE, we're targeting reducing the discretionary spend in the country by $200 billion a year. The total cost of this is $3.7 billion. Take a tiny part of the savings and reinvest it into a dividend for every child in the future of America. Next year's our 250th anniversary as a country. What better gift to give to every future generation than to put this in the pocket of all of those kids? And it acts as a 401k, and we'll be announcing some things. We have companies from Uber to Dell, from NVIDIA to AMD to Oracle, who've all committed that if we get this created, they will match into the accounts of the children of their employees. Tens of millions of employees now represented.
That's amazing.
I have private market philanthropists like Michael Dell who will contribute into the accounts. We have 20 trillion of wealth transfer that's going to occur in this country. We can't give that away. How is Elon going to give his money away through private philanthropy? It doesn't work.
Right.
But by creating this national infrastructure, we now create an infrastructure not only for moms and dads and kids to save, right? But we create an infrastructure for corporations to contribute and philanthropists to contribute in a very powerful way. So I'm not stopping until we get it done. And I think we have a really good shot at getting it done and getting it done soon.
Well, if anyone can get it done, it's you, my friend.
Thank you, my friend.
And you can come back next year and tell us all about it.
Let's do it with Jared.
Awesome.
All right.
Thank you.
Thank you all.